Hello and welcome to another episode of IPO KYC. Today, we do the KYC of ESDS Software Solutions. It's one of the only two Indian players providing the full spectrum of GPU as a service, cloud managed services, data center infrastructure, and software solutions. Last year, the company's top line was 472 crore with margins of nearly 50%. The company is looking to raise 720 crore via this IPO. It's a pure fresh issue, no offer for sale. Price band at 408 to 429 with a market capitalization at 5,000 crore rupees at the upper end. Mr. Piyush Somani, MD and Chairman of the company, he started the company more than 20 years back, is here with us on the show. Piyush, thank you very much for joining in. Very simply, what does the company do? If I'm an enterprise client and I come to you, what services do you offer?
So we are a full spectrum cloud service provider. We offer cloud infrastructure as a service. We offer data center services also. So this is part of our infrastructure as a service.
Which is about 40%, 45% of your revenues.
About 45% of our revenue. And then we offer managed services. So there are dozens of managed services, can be a database managed services, OS managed services, cybersecurity managed services, storage managed services. So there are dozens of such managed services. And then there are a set of softwares that we have. So application performance management, AI observability, an auto scaling stack is there, a DAM tool is there.
Okay, so if I'm an enterprise customer, I take your proprietary cloud, and here you're not providing third-party cloud services from AWS, Microsoft. You have your own cloud services, which is Swaraj. On that, you will manage all the infrastructure with cybersecurity, etc.
Correct.
Right?
Correct.
So it's a full end-to-end spectrum.
Correct.
Okay. Now, last year, the infrastructure as a service only grew 2%, despite a very large cloud opportunity. A, why is that? And two, if someone who signs you on for cloud automatically moves to managed services, but that grew more than 150%. So explain the divergence.
So last year, we did not invest. We did not have our own capital at that moment. We reached out to partners, global partners, and they had no limitation in spending. So taking either debt or taking either equity, we identified such partners in international market. We arranged our customers to take the infrastructure on lease, hourly basis on lease from them. And we helped our customer to run their services on top of it. So our managed services were brought in picture and we delivered those solutions. Now we've started co-leasing those GPUs from the partners, and then we are now able to further lease it to our customers by loading our Swaraj cloud on top of it. So the only change that has happened from last year to this year is that now we have entered into larger contracts directly with our customers, and at the back end we are orchestrating with multiple partners who are giving platform to us, like the GPUs to us and the storage to us, the data centers to us. We lease everything, put our Swaraj cloud on top of it, and give a combination of 40-45 services as a solution to our customer.
Okay. So the difference is last year, your clients didn't want only CPU storages or CPU-based services. They wanted GPUs, and you all didn't have it.
Correct.
Which is why you all had to go outside and partner with companies who could have provided the GPU infrastructure.
Yeah.
But now that is changing.
Yes.
So now you've raised some incremental money. I think about more than 400 crore rupees is coming fresh issue.
Yeah.
720 is a total fresh issue, but part of that you've explained.
576 would be for capex.
And explain that capex to us. How much of it is going in purchasing these GPUs?
So close to some 700, 800 GPUs would be coming in, and then we will be putting some data center capacity also in India. So that will help us to scale up some capacity in India. Sorry, you.
No, go ahead.
Yeah. So, so we will be putting some 700 to 800 GPUs in India and a few megawatts of data center capacity in India. But outside India, we will continue to scale with partner business model, where our partners are very comfortable putting in data centers for us. They are comfortable buying thousands of GPUs for us. And then we identify customers, and customer wants a complete end-to-end solution. Customer is saying that I just don't want the GPUs. I want complete AI observability. I want a complete solution. So satiate my business hunger. Don't give me rice or don't give me the masalas. I want complete end-to-end solution. And that is where we are seeing an opportunity.
And this GPU as a service, You all don't sell standalone GPUs or lease out standalone GPUs. Again, it's the full service. What is it as a percentage contribution?
So this is growing big time now. So what it was until last year was very small, but what we see.
What are the numbers?
So until last year, it was in single digits only, the revenue coming out of the GPU business. But in the running financial year, we see significant growth coming from that business model.
Take us through your $1.25 billion AI infrastructure contract. Give us details about with this Australian customer.
This is an Australian service provider from whom we are leasing this 8,200 GPU cluster. So we reached out to them. So this started last year when the customer reached out to us and said, like, is this possible for you to give this kind of a cluster? And obviously at that moment, we did not think that we had the capability to give this kind of service. We started talking to partners in the European region. We explored data centers over there. Then we came across Sharon AI in Australia. And then we signed up with them, and they agreed to deliver this large cluster to us. We put everything on top of it and gave a proposal to our customer. Customer liked it, and a deal happened there.
So this is fully booked out?
Fully booked out, yeah.
And what are the kind of margins you will make on this?
Margins are pretty good in this. Obviously, because the capex is not sitting on our books, so the ROCE margin are more than the industry standard.
No,
40%.
what would you make? Because you're also leasing these GPU clusters from Sharon.
Because that's not disclosed in the RHP, so that's the reason I cannot disclose what we are going to make, but our margins are going to be good here.
Is it margin accretive or dilutive?
No, so margin is expected to grow in the future.
So it's margin accretive.
Yeah, because the GPUs are appreciating. The reason is that the appreciation of GPUs is happening. We've locked these GPUs for 7 years with Sharon AI. So we have an opportunity to increase the revenue in the future.
But that can also change if the GPUs start depreciating, or in a way they become obsolete as well.
In next 5 years, that's not a possibility. That's what our estimate is. Reason being, no major semiconductor capacities are coming anywhere in the world. So whatever will happen in India in the next 2 years' time, very small quantity of GPUs will, semiconductors will come out of India. And what we are seeing outside India also, so be it the Hynix, SK Hynix and Micron, Samsung, everyone, they are not coming up with any large capacities in the next 5 years' time. So the GPUs will continue to appreciate for at least next 5 years is what we can foresee.
And $1.25 billion, which you have disclosed, is the revenue from this contract?
No, this is what we have to pay to Sharon.
You have to pay to Sharon AI. So what is the revenue that you will be making?
Our margins are good here. We have not disclosed what is our revenue here, but our margins will be good here. The PAT margins are also in double digits. So
this is the cost. $1.25 billion is the cost for 7 years.
For 5 years.
For a period of 5 years. And over and above that, you will be making revenues.
Correct.
Okay. So you have now contracted for 8,000 GPUs as of now.
Yeah.
Are you looking to scale up this business, providing GPU as a service, sign on more clusters with other companies, or maybe even expand your deal with Sharon?
Yeah, so we will expand with our existing partners also, and new partners have also been identified. So we are planning to scale into multiple clusters across multiple regions.
How soon? How large?
So work in progress, because every cluster takes 8 to 9 months to deliver.
But how will you fund this $1.25 billion over 5 years?
We are part of that ecosystem now. We've been approved by the vendors who are there, the OEMs who provide these services. Because we are part of that ecosystem now, lenders are comfortable to give to our partners, and the partners are ready to sublease it to us. Means like lease it to us, and then they have no problem that we are subleasing it to our customers.
So this is debt in a way, or
no,
is just
not on our books.
Not on your books.
Yeah.
And needless to say that as you scale up this GPU business, the 50% margins that you reported last year will hold.
Improve further from there.
Actually, what led you to double your margins? So, not double, as in they were 35% in FY24, and now we're at 50%.
So obviously, artificial intelligence, two ways our AI is contributing in our growth. One is by helping us to cut down on the number of people that are required to manage large clusters. So obviously, if you have to deliver so many AI factories, you would have required so many more people, but that's no longer required. We've been around like 1,000 people, 1,100 people from last 4 years, and revenue is growing. So the cost remains stable there. People cost is stagnating around that same number, and it may grow by maybe a 5%, 10% YOY on that cost only. And then bandwidth cost, power cost, that's not growing at the percentage of the revenue. Revenue is growing at a different percentage, and that cost is only growing incrementally to the previous years of that particular component. So that's why we are seeing that our profit margins are getting better.
What's the biggest risk you see on the horizon?
So obviously this is a highly regulated industry, and this is we all know which country controls the entire. So we have to make sure that we always follow the rules, and we always maintain. So you have to maintain a lot of confidentiality. You have to remain humble in this entire business, or else like one country can actually make life difficult for you.
So your moat, Piyush, is just the fact that you provide the entire stack of services end to end.
Yeah.
Because tomorrow I can also go to GPU-based data centers, and everyone's coming up with GPU-based data centers in India.
Yeah.
So your advantage is providing the full stack?
Full stack. Satiate the customer's hunger and just don't go
No, I mean,
with the rice.
you can fulfill a customer's growth ambitions even doing it outside.
Yeah.
That's right. You go to a GPU-based cluster from a Iota, for example.
Correct. And we partner with them also.
You partner with them for?
So we lease from them also.
You lease from them also. So what would top line look like, right? Now with this coming on stream, today you're less than 500 crore in terms of revenues.
Yeah.
3 years, 5 years later?
Can't project so easily because when I see growth of my partners outside India, look at Sharon AI, the way they are scaling up, like from just a single-digit $1 million revenue last financial year to few $1 billion of projection for the next few years. Look at the way E2E has grown. The Q1 numbers of E2E have been phenomenal. So their year end number would be very different from what it was the previous year. So we see that the numbers are going to be good for us.
Your bottom line is also doubling.
Bottom line is also growing.
You think that is possible?
We have to make it possible because this is the market where you have to capitalize. You have to capture this market and make maximum money for yourself so that you can scale the business and serve more customers, larger customers.
And what percentage of your revenues today is subleased, where you're leasing the infrastructure from your partner versus owning the infrastructure?
In the last financial year, around 80% revenue was coming from our own infrastructure, 20% came from, but yeah, moving forward, there would be a balance of both. Some maybe 50% would be coming from our own infra, 50% coming, we will be riding on the partners' infra also.
What are the lessons that you've taken from E2E networks?
Obviously that you have to keep patience and keep on doing right things. They have focused on doing right things. Market will automatically appreciate you. Not to try and do too much. Just focus on your business model.
Their margins are close to 80%. Do you think that is the benchmark?
85% is the standard. They should be reaching around 85% EBITDA margins.
So that's the standard in the industry for a business like yours.
Globally, I have seen that is a standard. You have to make an 85% EBITDA margin.
Okay. Piyush, lovely conversation. Thank you very much for joining in.
Thank you. Thanks a lot.
Thank you.
Yeah.
Thank you for watching us on CNBC TV 18. For all news and updates, subscribe to our YouTube channel and watch us on all social media platforms.